We have a management software, use Appfolio. Obviously, that is critical for operating scattered site or operating, 200 single address property. We work with this company called Interactive AI, and they built a chatbot to go onto our website. But we uploaded like 1,000 questions and answers into that thing. And it's so smart that people will ask questions and they'll go there. It might be tenants, might be prospects, might be clients. But the data that we're getting back from that is that there's 200 interactions, average of 200 interactions a month on this chatbot. And a lot of them get resolved, which just means it's less distraction for the resident support person, less interactions for the property manager.
I like just the objective of like, let's introduce one new piece of tech each year, because it's like the landscape is changing so quickly right now as we speak. That almost has to be like an objective for the business. You're going to start getting left behind. What's going on, everybody? Welcome back to the Multifamily Wealth Podcast. In this episode, I'm chatting with Michael Root, who is a Chicago-based multifamily investor, and an investor who has a significant amount of experience on the operational side of the business, given that him and his team manage everything that they own in-house. And that's really what we spend a lot of this episode talking about, is how to effectively manage scattered sites, multifamily properties. And I think this is going to be a great episode for the operators out there who want to better understand how to manage a large number of properties, not just units, in terms of just a high number of properties that are spread around. I believe they manage 80 buildings, 90 buildings or so, 900 units, I believe. And it's much harder to manage that amount of units when they're not all consolidated into a few larger communities. So we really go deep on operations in this episode, where we're talking about how to optimize your lease renewal rates, how to really build community and to build relationships with your residents, despite the fact that you're managing in a scattered site situation and that you don't have on-site staff. We spent a lot of time talking about the tech that they're using and that they're adopting on a regular basis within their management company. And I think this is just a great episode as it relates to understanding how to effectively operate multifamily, as well as how to think about buying small assets. And we get into their, kind of buy, sell, refi thought process around growing their portfolio as well. So great episode for all of the multifamily operators out there. And if you're a passive investor or somebody who's not operating multifamily, you're still probably going to get something out of this episode as it relates to understanding what is happening behind the scenes in the deals you're investing in if you're buying these smaller deals. Michael, welcome to the Multifamily Wealth Podcast, man. How we doing?
We're doing great. Thanks, Axel. Appreciate you having me.
Absolutely. I'm excited for our conversation here because I know that I think we're running pretty similar businesses in the respect of being vertically integrated, having a pretty narrow focus from a market standpoint. I think, one thing, you're not buying properties in the Sun Belt, neither am I, which already kind of puts us in the minority of podcast hosts / guests. So yeah. I think a lot of folks are going to get some value out of this episode, one, operationally, two, just taking an alternative view as it relates to where we're buying deals relative to what a lot of folks are talking about online. But before we get to all of that, let's start with your background. What were you doing before real estate? How'd you find the real estate business? And what does the business look like today?
I was on LinkedIn the other day and I went to my profile to look at something, and right underneath my name, it says, been at Root Property Group for 19 years and 10 months. And I didn't realize
that scared you.
Months out from April will be my 20th year anniversary. So wow. What did I do before this? Nothing. Like I was in college. My dad had like a small property management landlord type business in the Lakeview neighborhood of Chicago back in the late 70s, early 80s. And that's kind of where I was always like headed towards. Like I got my real estate license when I was in college, did some leasing work for him on like summer breaks. And like the weekend after I graduated, like I was at his office, like, okay, I'm here. Now what? So I didn't do anything before this. And it's completely different from what it was in 2005 to where it is today. I mean, like typewriters and like all that stuff. So my background kind of evolved from going into this sleepy little office where my dad and a couple other people, and they were just managing the 7 or 8 apartment buildings that he owned at that time. And I started doing the leasing there. I started doing the property management there. I started trying to do new business sales. And it was all like, what I was trying to grow was like third-party property management. And then We did that from 2007, 8 through 2013, 2014. And that's when we started being like, all right, we've created so much value for our third party clients in terms of like stabilizing their assets and adding value to them. We need to start doing this for ourselves. And we really shift focus, I think in 2014, said, all right, let's start buying our buildings. And that's kind of when we started that. And that has been the primary focus. Since then, it's definitely been a change that we've all really enjoyed because it's easier making decisions on problems at buildings that you have an ownership stake in than going to somebody else and saying, hey, you have to spend $45,000 to replace this back deck or something like that. So just from that perspective alone, it's a lot more fun, a lot more enjoyable.
Yeah, absolutely. I mean, I would imagine, our management company, we do some third party and then we manage our own stuff. And it's interesting. It poses an interesting set of challenges as it relates to, at least in our world, how we've structured the business and, how we've made like hiring decisions. I know that we did it initially. One of the core reasons that we decided to do third party, in addition to just managing our own stuff, was when we started, we only had like 70, 80 units in terms of what we owned. And it was like, well, we can't really hire many people here as it relates to building some type of business that isn't fragile and that doesn't drag us into the day-to-day management at a level that we wouldn't like to be involved in. So it was like, we kind of have to go out and do third parties so we can get to a couple hundred units, few hundred units under management so that we can hire a PM, a leasing agent, a couple of maintenance guys. So we have some scale there to actually manage, but it can be tricky as it relates to it's another line of business that needs to be managed. And obviously, you got to provide the customer service and support to the owners as well as the tenants, right? It's a two-sided business on the third party side. Are you guys still doing third party now? Is that still a component of the business itself, or did you kind of phase out of that as you guys started to buy your own buildings?
We've phased out of it. I mean, there's a handful of accounts that have either been with us for a long time or strategic partners, I'll call them, because they've invested in deals that we're doing, or just have potential for growth. But it's not something that we have pursued in a number of years. The third party management is great though. I mean, when we started buying our own stuff in 2014, like how are we buying these buildings? It was from like the fees we were earning from managing other people's properties. And so we needed that to kind of like get us into the groove. And, once you have a couple deals down, then you start forming those relationships with brokers and most importantly, the lenders. And then stuff just kind of starts becoming a little bit easier. So yeah, no knock on third party management. It's a great business because you can earn, recurring revenue. And if you have your operations down tight, you'll have happy clients. And normally you keep those accounts for 5-10 years before they exit because they sell them or something.
Mm-hmm. No, 100%. Yeah. I mean, it's nice and sticky recurring revenue for sure. And especially as it relates to like, if you're going to be buying assets and you have the decision of, okay, I have my own management and I'm going to manage it with my own team versus I'm going to take it to third party. LPs and lenders prefer the route of you're managing this in-house significantly more than you're taking this to third party and relying on a third party PM to actually execute your business plan. So that's kind of night and day as it relates to your ability to raise capital and secure great terms from lenders. So 2014, you start buying. It sounded like your dad had a handful of buildings back in 2005 when you joined, and the focus was third party between maybe 2005, 2014. 2014, we're going to start buying properties internally. Obviously, that's over 10 years ago now. Like, what's kind of been the trajectory over that period of time? Was it, let's start with small communities, small buildings, and then we're starting to organically scale? Did you just jump right into doing larger deals and raising money? To kind of take us through the growth cycle there over the last decade.
I mean, the first building I remember we bought was a little over $1 million and it was 8 units in a good neighborhood.
And this is all Chicago, right?
Like,
I don't know if we touched on that, but just to make sure that we did.
I'm sorry.
This was all Chicago, right?
Yeah, all Chicago. Everything that we've done has been in the city of Chicago. We have looked at kind of getting into other markets, but I think this is our backyard. And that's like a lot of the value that we bring is kind of like what you just mentioned, that, people want to get involved in the deals with us. The lenders like lending to us because of our track record, because of the history that we have here. And we are hands-on operators. So I wouldn't have that value if we went to, Phoenix or somewhere far away,
Yeah, you're losing our competitive advantage. Exactly.
Yeah, definitely.
I interrupted you though. So 8 units in Chicago, kind of that first deal, just over $1 million.
Yeah. And we still own that building today, and it's been a great building. And I feel like there was deals. I think the one after that was probably under 500 grand, but it was a quick, like, renovate and then stabilize, and we still have that building. So it's been all over the place, but I think our strategy and our goals are to, I'd say, buy between 1 and 4 buildings a year that are within like a 1 to 3 million or $4 million range. And then one deal a year that's like 10 plus. And so the strategy there is we're keeping our people busy with the new acquisitions. We're keeping our renovation crews busy, which is like the most important thing. And a lot of those are kind of like fixed, stabilized, and then we'll exit them. And then the bigger buildings, the more expensive ones, we'll try to like refinance and keep.
Got it. Okay. And is that kind of the decision point as it relates to whether or not you're going to hold something longer term versus sell it is purely size, or are there some other considerations when you actually get to the finish line on these projects as it relates to, do we sell it? Do we refi it?
It's usually size. I mean, we've had so many 8 and 10 flats and even 4 flats and 6 flats that, it's just kind of like, these are like low hanging fruit, and we can add some value to these and then put them on the MLS and find someone who's not necessarily like a professional operator that we're competing with or that we know in our market. And so we might be able to get a premium on these types of buildings because they're at a price point where, a group of buddies gets together and they say, let's buy our first 6 flat together. And I kind of have a nice neat package for them with clean leases, clean units, good tenants in there, and they pay a premium for it. So that's kind of like low hanging fruit. I think it's kind of like get in, get out, and then use that money and roll it into something that is kind of a bigger picture that might take us a little bit longer to stabilize, but is something that if we refinance can be a very nice asset for years to come.
Mm-hmm. And I mean, let's kind of I want to narrow that question down a little bit, because I think in our business, it's similar, right? It's like smaller stuff. It's a little harder to own long-term because you don't get the economies of scale. If you have a 6-unit building and a tenant moves out, you're whatever that is, 16% vacant, right? So it's a little bit harder as it relates to the ongoing cash flow forecasting for a building like that versus something that's 30, 50, 60 units, whatever it might be. But let's take an example of, we got something that's like a little bit larger, maybe 15, 20 units, or, it's within this 15 to 30, 40 unit range. Are you kind of permanent, goal being we permanently hold all of those deals regardless of the attributes or the dynamics, or there's some other considerations when you get into that size range? And you're like, okay, we're thinking about selling something. How do you determine maybe what you want to sell or which properties you want to get out of versus hold? And maybe the answer is you don't, because you hold them all, longer term, or that's the goal.
No, that's a great question. And I don't know if there is like a science to it. I think it's who's involved in it at that time. If it's me, my brother, my sister and her husband, if it's the 4 of us, it's probably something that we're going to hold for a long time. It might be something that we might be able to pass down to our kids. If it's an opportunity that comes along and I happen to have, a friend in the business or something, that's like, hey, I want to do this deal. I'm looking to put some money into something, and something kind of comes along. I'm like, hey, I'll do this with you. Just follow, it just came across our desk. There might have to be a little bit more finite strategy in something with having like an external partner where it's like, all right, this is either like year 5 or refinancing. If we can't get more than 60% of our initial capital out at the refi, then we want to look at selling it. And if we are able to refinance it, then we'll keep it for another 5 years. So keeping a property for 10 years is a pretty long hold.
Yeah.
So, I mean, there might be a refi and a sell and then a sale in a situation like that. But I think it depends on the partners and what they want out of a specific deal.
Yeah, no, I think that's kind of the reality, especially for a lot of the folks listening who are either looking to raise money or partner with other folks. It's like, the more individuals you have involved in a deal, especially if you compound that with some level of distance in relationship. Like if you're doing a deal with, your brother, for example, right? Like that's a totally different dynamic than you're doing a deal with a couple of guys you met a year ago and you've networked with for a little bit. And you're kind of jumping into a new deal. And as you mentioned, 10 years is an extremely long time to hold a piece of real estate. And I think people just kind of get into this and they're like, yeah, we're going to buy stuff, we're going to hold it forever. And it's like, well, at some point often you maximize your value and you're like, I've outgrown this deal. I've gotten into another I got into another market, or I started to change asset classes, or I want to do bigger deals and I want to sell this one to fund these bigger deals. So that's understanding that that is the reality, especially when you're buying something, I think is important. It's great to have that goal, but there still needs to be some mechanism of which you can exit it, especially if you got some partners involved too.
Yeah, I've got like a pretty good example of something like that where it's a really nice property and it's 35 units that we bought in 2019, maybe 2020. And I got it off market because I was staying in touch with the guy that owned this building. His family owned it for like 45 years. Stayed in touch with him, stayed in touch with him, stayed in touch with him. And then one night we were hosting this event in our office where it was like we invited kind of people from the neighborhood and said, we're going to talk about capital gains and these things. If you're interested in multifamily, like come meet us, we're going to talk about it. And he showed up and he said, "Hey, Mike, good to see you. Like, I think now's the time. I'm ready to, and here's my price." And, we said, okay, and we bought it, and it's a fantastic building. And it's been, it was a studio building, and the average rents in this building when we bought it were $630. And then I went in and we spent 3 to 4 grand, I'd say, in units, just kind of like cosmetically making them nicer. And today those average rents are closer to 1,100. So we didn't spend a lot of money to get a huge bump in the rent. And so that's a situation where I thought that was a building we were going to own forever. And a broker approached us and was like, "You should consider selling this because this is what I think I could sell it for you." And we kind of had a real conversations with ourselves, and we're like, well, what more can we do with this building that we haven't done in the short 4 or 5 years that we've owned it? It's like, it kind of makes no sense to continue to hold this one.
Mm-hmm.
So I think
more or less at the whim of the
that is
market at
another
that
example
point.
where it's like your strategy might change depending on like how the economics of the deal go.
Exactly. I think especially with folks who are doing value add deals like what you're doing, what I'm doing, what most of the listeners are doing, it's, you really are paid for all the work you're doing, like at closing. By ideally you're buying a good deal at a, below market price. That first 12 to 24 months, like implementing the business plan. And then once the building's stabilized, you're basically at the whim of what the macroeconomic environment of that specific market does. It's like, are rents going to go up, or are people moving there? And you can operate well, obviously, and squeeze, a few more percentage points in terms of like a cash on cash return or what have you over the long term out of it if you're a good operator. But the bulk of your returns are probably tied to that area versus your ability to really effectively operate. Because it's like you close first couple of years, that's when you're creating the bulk of your returns. So it's like after that, there's got to be a real compelling reason to hold on to something. And there are, you get the tax advantages if it's a growing market. You want to keep riding that train there. But it certainly becomes much more of a conversation when you've kind of quote unquote done your job. Now, this is going to get really granular. And I think this will be something that's interesting for folks to kind of get your opinion on. And it's sparked by your comment about this building being studios. And quick setting the stage here, like in our market, we like to go after deals with more bedrooms in them, right? Because ideally you get, whether it's a family or you get a few roommates versus, one guy, one gal or something in a studio or a bedroom, which typically turn over a little bit more often. So we get a little stickier tenant base in buildings with higher bedrooms. Like that's one thing that we look for. And there's a whole slew of other things that we look for. But in your worlds, whether it's when you're underwriting a deal, like specific attributes of that property that you really like to see or that you want to see, or that gets you a little bit more excited, or maybe components of like a neighborhood that get you a little bit more excited, whether it's we're want to more aggressively pursue this in terms of the offer we make, or it's more likely that we're going to be holding this long term. And this is going to be the one that we refi over and over again versus sell. Are there things that you're looking for as you're going out there and, either buying deals or determining whether we're going to sell that one or hold on to it?
Yeah. I mean, I don't like seeing a lot of 3 bedrooms. I mean, like families are great, but the markets that we're in our demographic is typically like roommates and couples, maybe couples with like newborns. And then after that, they go a little bit further north or a little bit further northwest, or they go to the suburbs. So 3 bedrooms have always been notoriously like high turnover for us. The worst unit type that I can think of is a 3-1. I mean, 3 roommates sharing 1 bathroom, like that lasts a year, maybe 2 years.
Yeah.
I mean, my favorites are 2 2s, but there's not too many tutus in vintage buildings unless you're putting serious rehab dollars into them. So I like 1-1s and 2-1s, and I do like studios. I feel like studios are sticky, and I think they have the highest renewal rate out of any of our unit mix, which is
Wow.
little over 3 years. I want to say it is. So I like to see 2s, 1s, and studios, but no 3s. And then, yeah, I mean, depending on the neighborhood, if it's somewhere that's kind of like far from my office or far from where we have all of our other properties, it's probably not something that I want to hold long term, just because I don't want to like deal with driving back and forth from there all the time. You know, I wear a ton of different hats here, but I've kind of fine tuned it over the years. But like one of my main jobs, I think, is like after we close on a deal, I'm kind of wearing the like execute the strategy hat, call it asset management maybe. So the quicker I can kind of like make sure the renovation work is done, make sure the leasing team is hitting the right numbers on the lease up. That's kind of like, as soon as I can get to that point, that's the point where I can kind of go back and put my buyer hat on and start looking at more deals, because I'll be so involved in that, making sure that, all the money we just put in this building, I'm doing everything I can to make sure that we hit that plan, which is, I think that's a good thing. Maybe I'm not, marinating my pipeline as often as I should, but what's more important than like executing on your plan, right?
Mm.
I kind of always think about it like that. So long term, depending on who the partners are, proximity to the other buildings; short term, maybe the neighborhood that I'm not necessarily interested in, but looks like a good price and looks like there's upside on rents with a little bit of reno. Then those seem to be the ones that are, flipped in a year and a half, 2 years.
Yep. No, it makes a ton of sense. Now, before I ask this next question, so total portfolio size right now in terms of like the units that you guys are managing, because it's obviously a lot of smaller, small to mid-sized buildings.
Yeah, our average building size is 10 units, and we have about 800 units.
Yeah. I mean, that's a lot of individual addresses, obviously, right? I mean, well, 80 being the rough number of buildings there, mental math.
Yeah. Yeah.
So there's all kinds of challenges, obviously, when you're managing scattered site, right? And that's our whole business too. Like our PM company manages, I think we manage like 700 and change right now, but it's like 80, 90 buildings, all kinds of challenges that come with that. You mentioned something before I hit record where you've talked about how you guys actually can build community despite the fact that you operate a scattered site portfolio. Don't even have a question. I'd just like you to expand on that in terms of, because that's usually the most challenging thing to do for folks that are managing a whole bunch of different properties spread throughout a market.
My buddy moved down to this awesome town in Florida 2 years ago. And just a few weeks ago, me and my buddy that lives in Chicago flew down there, played some golf, and saw what he's got going on down there. And he lives in this huge rental complex, a very nice building with like a pool, clubhouse. And like people were using these things in Chicago, and like the skyscraper buildings that have amenities like that. Like you go in there and there's like rarely anybody using these things. But down at this guy's place in Florida, I was in the elevator and they had the management company put signs in the thing about like, it was almost Valentine's Day, and they're like sweetheart pizza or something. They're just like, come on down. We're going to have free pizza and soda from 5 to 7. So stop in on your way home from work and stuff. And I was like, that's nice. They're able to do that though, because, they have probably 300 units in this, complex. But if you have 80 buildings with 10 units apiece, like how do you replicate that? Because I think it is important. So some of the ways that I think we try to achieve it is consistency. We have something we call a resident service model, where it's like any reasonable request, the answer should always be yes. Like make the tenant happy. Like if it's not going against the lease or if it's not losing property money, like let's try to accommodate. But we have our different property managers assigned geographically to the different properties. So any given day, any given week, they might have 10 properties and, a mile radius of each other. And they're going around the properties, and we check them on daytime. We check them at night to make sure you can see the lights on and stuff. It's part of our process. So there's familiarity with the tenants and they see their property manager on site often. I think that's a way of building community. Tying that in the resident service model, standard operating procedure is that. So it's like we're always delivering consistent messages. We have the same maintenance tech that services each building. So it's like if you need something done with your shower and then you need something done with your kitchen cabinet like 2 months later, like you're going to see the same guy, most likely, unless it's a specialty job. Anytime we have new move-ins, we send out this internal email with like a picture of the tenant and where they're moving so that everybody who's associated with that portfolio or that property sees them. So they can be like, oh, hi, Axel, welcome. I hope you like your new apartment. And then the guy's never seen, you may have never seen this person before, and they just said hi to you and they knew your name and they're wearing, Root property gear. That's like it makes you feel important and it's an easy thing to do.
Mhm.
So that's kind of a few of the ways we try to do building community with just consistency and a consistent message throughout the entire company.
Yeah. And I think it's one of the harder things to achieve because as you mentioned, I live in a big building down in Boston that's got a couple hundred units in it. And we get the so-and-so event over here in the common area on this date and that. And it's much easier to manufacture community, well, to kind of either build community or to do community events if you want to go that far. If all of the units are under one roof, so to speak, and you have a large concentration of them, obviously that becomes more challenging in a scattered site situation. But I think I like that tip as it relates to like when somebody moves in, there's a proactive, like everyone that individual is going to be associated with or interacting with throughout their life of residency in that apartment, being proactive around that so that there's, that they're up to speed much faster. Whereas you get that in an on-site building where, the property manager kind of walks you in and gives you the keys type of thing. And you see them when you come back to your building on a daily basis. But obviously you don't get that in a scattered site situation, right? So there's a little bit more of a disconnect between property management staff and resident, but you're almost like manufacturing more touch points there, which I think is really valuable. And the other thing I wanted to talk about is your lease renewal rate, which you mentioned 82% in 2024. And there's another, kind of dynamic or something that we were talking about before we started recording here, but that's obviously an impressive renewal rate. And I think nowadays everybody's trying to optimize for renewals. I mean, everyone always is trying to optimize for renewals in the multifamily sector, but like really specifically in the last couple of years when rents have softened and lease trade outs you're not getting those bumps that you did for a good stretch there before 2022 and 2023. It's becoming much more of a priority, I think, for owners. What are some of the things that you do to really generate that lease renewal rate, maybe outside of just providing a good experience?
I think the good experience is the number one thing. I think as long as you are priced appropriately and offering like a decent product, there should be no reason for somebody to move out of your apartment unless they are, they have a life change, they're getting married, or they want to move in with a boyfriend or girlfriend. They bought a house, something like that, or they get relocated for work. I want to know when people don't renew. I like to hear like, what was the reason? Can you go ask them? Like, was it something that they didn't like about the building or neighborhood or what? So that's kind of like the belief that I have. If there's no good reason to move, they should stay. So I think it goes back to the resident service model, 90%. And I think that's the hardest 90% of it. And then I think the easy 10% is make sure that the snow is shoveled, make sure that the garbage isn't overflowed in the back of the building, make sure that the lights in the laundry room work and that there's not getting jammed up with quarters. So somebody has to wait with wet laundry, waiting for us to go over there and like empty the coin box. Just taking care of the building, I think, is the easy 10%. Having consistent, high quality customer service is the hard 90%. But I think if you do those two things, you'll have good renewal rate. As long as you're not trying to like charge 25% what the market rent is or something.
Yeah, exactly. Right. Assuming that we're, with reasonable increases here. Yeah, I think that's especially hard for people that are buying older buildings. I don't know how old the average buildings are that you guys are buying. I mean, maybe you can share that, but specific to like New England and New Hampshire, where we buy a lot of real estate, like we buy a lot of early 1900s built real estate, stuff that's 100 plus years old. And shit breaks all the time. So it's like, you got to fix it quickly. And that's the bulk of it, right? And then you start going above and beyond there. And that's how you really start to increase those renewal rates. But it's much more of a challenge to accomplish that than it is, specific to maybe what we're buying and the markets that we're buying in versus somebody who's buying, 1990s or newer, 2000s or newer built product where that stuff starts to take care of itself a little bit more. But you're really going to nail that if you're buying older real estate for sure.
And that kind of goes back to some of the questions that you were asking earlier about like, what's the process between like keeping it or flipping it? Like all of these things, like there's so many things that tie into that decision that, like we just, this conversation is, as this progresses, I'll think of more things like, oh yeah, that's another reason why we would decide to do this versus do that. But yeah, in Chicago, well, I would say the average age of our buildings are 1920, 1930. Um, and probably very similar type of buildings to what the stock in Boston is like too.
Yeah. I mean, anywhere that's, major city that's been around for, for, 150 plus years, it's like predominantly the housing stock is early 1900s to mid 1900s built real estate because it just got a lot harder to build stuff over the last 30, 40 years.
Yeah.
So you got to get good at owning and operating those buildings. And there is a skill to that because it's not the same as managing a nice 80s or 90s built garden style community in the Southeast where it's not getting hammered with snow and weather and this and that. Those are kind of two different businesses in a lot of ways. Let's talk about technology you guys are using though, because I think the use of technology, in my opinion, is a little bit more critical for PMs and managers who are managing scattered sites. You really got to be operationally dialed in as it relates to effectively managing your portfolio. Obviously, I'm sure you guys are PMs, you're using a PM software and kind of like the stuff that you obviously need, but are you doing anything on the tech side or on the system side that's like a little bit more innovative or that really helps you manage your portfolio more effectively?
One of the best ideas I think I've ever had was like every year we're going to implement one piece of new technology.
Oh,
I don't think we've kept up with that, but I think that was a great idea that I had. But I think today, yes, obviously we have a management software, use AppFolio. And we switched to that from something called Propertyware, I think probably in like 2016, 17, 18, something like that. Like we've been on it for a while now and like everyone knows it really well. But obviously that is critical for operating scattered site or operating, 200 single address property. Some things that we've introduced recently that have really helped. We work with this company called Interactive AI, and they built a chatbot to go onto our website. And I was kind of like, yeah, this is kind of like gimmicky at first, like it's just like people are gonna go to our website that want to talk to us, and they're gonna like probably like representative, I want to talk to a human. But we uploaded like a thousand questions and answers into that thing. And it's so smart that people will ask questions and they'll go there. It might be tenants, might be prospects, might be clients. But the data that we're getting back from that is that there's 200 interactions, average of 200 interactions a month on this chatbot. And it sounds like a lot of them get resolved, which just means it's less distraction for the resident support person, or less or interactions for the property manager. So something like that was pretty easy and it's not terribly expensive either. So I'd recommend like a chatbot on your website. I think one of the biggest game changers and like the leasing side would be the auto scheduling feature that you can like integrate into your online ads. And so I think that cut down so much time for our in-house leasing agents of the back and forth of, okay, you want to see this on Thursday at 1, I can't do that, but I can do 2. No, you can't do 2. Okay, let's do 4. It's just like automatically scheduled. So fewer agents are able to show more apartments through that. That's been great. Another really cool one that I found at a conference in Denver a couple of years ago was you take your photos of your like vacant apartments and you can send them to this company, and it's called Grid. And for $50, they can virtually stage these units. And you look at the pictures, a vacant apartment with a professional picture looks really good, but a professional picture with a virtually staged apartment looks like even better.
mm-hmm.
And it's for $50, and then they're yours to keep. So that's another thing that has been really helpful for us. This feature on AppFolio called Smart Maintenance to kind of automatically schedule which vendor we would want to be assigned to a work order has really helped cut down the amount of manual labor our maintenance coordinator needs to do. So it's basically like with all these tools, we're able to add on more and more units without increasing the amount of staff, which increases our overhead, obviously. I've been looking at things like Meld and Vendoroo is another one. We haven't pulled the trigger on one of those, so I'm interested to hear of like whoever's had good experiences with those, because I think that's probably the next bit of technology that we're going to incorporate.
Hmm.
Yeah, so I'd say those are like the main 4 or 5 that I just mentioned that have helped kind of propel us and take more on with the same amount of staff.
Yeah, I like your just the objective of like, let's introduce one new piece of tech each year because it's like the landscape is changing so quickly right now as we speak. That almost has to be like an objective for the business. You're going to start getting left behind. And I feel like over the next couple of years, there's going to be such a significant gap between, the quote unquote like legacy PMs or PMs that are run by owners or operators that are a little bit more kind of old school in their approach. Everybody uses property management software now. That's table stakes. Like everybody uses like a leasing platform, something to kind of help you lease a little bit more effectively. That's almost table stakes. A lot of people using kind of like global talent now, some virtual folks to, help in the back end for less than like the US folks. But like the AI stuff, the really, the smart maintenance, as you mentioned, like enhancing pictures, anything that's reducing any human interaction, like all the AI stuff, we haven't done that yet because I had the same reservations as you, where it's like, okay, how effective really is this stuff? But a lot of people just like need to get a question answered, like, and I would imagine this is probably part of like your, 1,000 questions and answers you uploaded. How do I apply for this apartment? Or like, do you guys take dogs? And stuff like that, where it's like,
Yeah.
it's probably on your website, but someone's probably too lazy to go search for it. So I might as well just ask this thing. Like I would imagine you're getting a ton of those.
That example though, like, do you guys take dogs? It'll respond and say, which unit are you interested in? And then they'll say,
Mm,
I saw this apartment online, and it'll say, this building does not take dogs. However, here's a list of buildings that we have in this neighborhood that do allow dogs. Like, it's really incredible. I mean,
it's
every time
wild.
you type something in ChatGPT, you're kind of like, oh, wow, that's really impressive. And it's the same thing with the chatbot. So, but it's tailored to your processes, and it knows what the terms in your leases are. So
Hmm.
it's huge. I would definitely look at that.
Yeah, no, for sure. I mean, that's, as an Appfolio user, like I think Appfolio specifically as a platform is, because we have some stuff in other markets where I'm a third party client of other management companies that use other software. And like both on the owner side and on the owner client side, Appfolio, I feel like is still kind of the gold standard outside of, some of like the real page stuff for really large communities where they got to like, they need their accounting to be kind of absurd institutional level. But for what we're talking about, I think Appfolio is still kind of market leading. And they're really kind of like leading the charge from an AI standpoint. I feel like I'm
Yeah.
giving an Appfolio ad right now, but I think that they specifically do a really good job of trying to introduce new tech like that. And it's just up to the user. Like you got to adopt it. You got to get on board with it because it's coming. You'd rather be early than late. Again, you're buying older buildings, you're buying small to mid-sized deals. Like there's a lot of overlap with the folks listening and our business. Is the model for you guys pretty typically we're buying stuff from a mom and pop with low rents, we're kind of renovating units, pushing rents, and then we're going to sell, refi, what have you, depending on the deal? Or is there some other kind of more specialized tactics you guys are taking to your deals that's allowing you to create, more value above and beyond kind of the standard stuff that a lot of folks do?
I think the former is probably my favorite type of deal, where it's something that's been owned for somebody for a long time, and it's probably in a good neighborhood. We possibly have access to it off market, which is always exciting. But even if not, you can just look at it and say, okay, we have 300 units in a 2 mile radius of here. We have a really good idea of what the rents are once we have new kitchens and bathrooms in there. So it's kind of like meeting the market strategy. I mentioned that studio building that we're selling. We only spent $3,000 in those units. Like we were not redoing the bathrooms. Bathrooms are still original. We put new countertops in, painted cabinets, refinished floors, changed light fixtures, painted
Hmm.
the wall, did the common area. That was meeting the market. Like I could have spent 10,000 in those units and done do new cabinets, new appliances, new bathroom. But I don't think I would have been able to break that. I don't think I would have gotten much more than the 1,050 rent that we're getting today. So that's incredibly important right there, is don't overbuild.
Yeah.
But I would say our typical model is adding value by not vacating a building as units turn over. We're going to go in there, refinish floors, update kitchens, bathrooms, light fixtures, paint, all that kind of stuff. Say 20 to 30 grand in a unit. Get the new rent, wait for the next one, turn over, do that again. And, in 2 years time, you may got through 75% of the units, 50% of the units, call it. So it's like a 3 to 5 year deal. And then you're ready to refinance in year 4 or 5.
Yeah. Straightforward stuff. I mean, it's a proven playbook for a reason. And I think that's just kind of the life cycle of real estate ownership. It's, you buy something, you make it nice, you kind of stabilize it. And then over time you optimize for the ease of operations, and you'd rather retain as many tenants as you can. And over 5, 7, 10 years for some of these owners, those rents start to lag, but it works for them because they're just, it's nice, predictable, easy to operate. And then they pass it off to the next guy who knows, they're going to go do the same thing. It's just kind of the name of the game there. And I think that your point about overbuilding is huge, like especially for folks that are doing deals in kind of like lower rent markets. Like there's some markets where you can take the risk of overbuilding a little bit more because, the market, just the rents are higher. And if you're going to spend another $5,000 because you maybe want to pick up another couple $100 a month in rent, but you don't get it, but the market rent growth is so high that it kind of bails you out. Like there's a lot of markets where that's not the case. Like a lot of the Midwest, for example, where rent growth is just a little bit slower on average than it is in the Northeast or on like the West Coast. Some of these more high growth markets where, yeah, if you're going to overspend on your units, the market's probably not going to bail you out with that rent growth to kind of compensate you for the CapEx you spent. So I think specific to folks who are in slightly more kind of, steady markets, for lack of a better way to put it, it becomes even more critical because you're not giving yourself a chance for the market to bail you out, which it did for a long time for a lot of folks, who were maybe over improving, but it's obviously critical to get that component of it right because it's an easy thing. I think so many new investors love to do that too. Something about a new investor loves to make something really nice and then realizes that there's a cap on what you can charge in that certain area. And they learn it the hard way.
Yeah.
Awesome. All right, Michael, this has been a great episode. I want to make sure I get you out of here on time. Where can folks learn a little bit more about you, learn more about Root Property Group, and connect with you?
Thanks, Axel. Yeah, this has been a good conversation. Root Property Group, you can get some info on us at rootpg.com. Feel free to email them. And do I give my email address or just
go for it? Yeah, I'll link it in the show notes. Yeah.
My email is mroot@rootpg.com. If you ever want to reach out and are interested in hearing about Chicago investment deals that we're looking at, try to do 3 to 5 of them a year. So pretty good volume. It's probably the hardest thing is keeping up with that pace. It's probably the hardest thing in this job.
Yeah, because you can't force it, right? It's like the deals still have to come to you in a sense, despite the fact that we don't want to grow. Sometimes the market doesn't let you. Yeah, exactly. That's a common challenge, I think, across all markets, all real estate investors. But no, it sounds great. I'll link all that in the show notes. If you're in Chicago, certainly reach out to Michael. And if you're looking to maybe place some capital in Chicago or you want to get into some deals in the Midwest, obviously reach out to Michael as well. But thanks again for your time, man. This has been a great episode.
Thank you, Axel.
So again, if you haven't given the podcast a rating and review and you enjoy this episode, please take 10 seconds, 5 seconds, I think is maybe all it really takes to scroll down on iTunes or Spotify and leave a 5-star review. But again, I appreciate all of you listening, and I'll catch you guys on the next episode.